Okay, good evening everybody and welcome to all of you at ACCA Prepare to Pass session. Today we are discussing day 5 of corporate reporting P2 and today is 10th of December. So the first question that I usually ask for the students is what about the home assignment that I have given to you? In first day 1, day 2, day 3 and day 4 I have given you 4 home assignments. So how many of you have completed the assignment? Please write your feedback about the assignment in the chat box, please. Please write the feedback of the assignment, that how many of you have covered the assignment. I have an issue on how to answer question 2 and 4. I need to know, is there a technique? Such questions. Please write your feedback, that how many of you have attempted the questions and home assignments of day 1, day 2, day 3 and day 4. I'm waiting for the feedback of the students still. Day 1 and day 2. Okay, so we have received some feedback from the students that some of students have attempted all the questions, some have attempted just day 1 and day 2, and there's a feedback that I have sent you an email. I have not been added to the WhatsApp, and my work and home commitment have not afforded me to time to complete the assignments until the weekend. Okay, please try to do the practice. It is not compulsory to do the assignments, but it's all useful. You people have your own commitments, but it's highly recommended to do these assignments till at least in the month of November, and if it is possible, you can do it on weekends. So it's important for all of you to please attempt the mock at least. Please attempt the mock at least, so that we can discuss the mock and you will be able to analyze and identify your position, that where you are right now. So you have to make the position analysis of yourself about the preparation of paper P2. So it's very important. And there are some students who have not yet added on the WhatsApp group, so please click on the link you can see in the chat box. Just click on the link, then you will be automatically added in the WhatsApp group. Okay, so let's start from the first slide. This is again the format of the exam that we have already discussed in day 1 session. Then we have, yes, the new standard and one of the most expected standard that the examiner can ask in this session. So IFRS 16 is actually a new standard. It is the replacement of IS 17, and it has been used in place of IFRS 17. Okay, so let's start. Why it's not moving? Okay, thank you. So let's start. IFRS 16 is about the lease. So first of all, you should know what is exactly lease means. Lease involves two parties. One is the lessor and the other one is lessee. Lease means the right to, it's the right actually to control the use of the asset. So in fact, we are giving the right to use the asset to another party, and the party who's taking the asset and who is taking the right to use the asset will be called the lessee, and the party who is giving the asset against some consideration will be the lessor. So lease is actually an agreement in which one party transfers the right to control the asset. Previously it was the right to use the asset, but now it is the right to control the asset has been transferred from the lessor to the lessee. So it's not compulsory that in all the leases that the lessee should have to purchase the asset. It might be like this, that lessee has obtained the control of the asset for some times and return the asset to the lessor after the initial lease period. So IFRS 16 is actually the advanced version or updated version of IAS 17. So previously we have operating lease and finance lease, which has some weaknesses, and now we have a single module, that is the right to use the asset. So in a very simple terms, you can say that the change of between the IAS 17 and IFRS 16 is the major change is that previously we have two classifications. One is the finance lease and one is the operating lease. And now we only have one classification, that is in fact finance lease. But the name is not a finance lease. The name under the new model is the right to use the asset. So effectively the change is from the books of the lessee, the concept of operating lease has been removed actually, but the concept of finance and operating lease is still under IFRS 16 from the lessor perspective. So for the books of the lessor, still we have operating lease and finance lease concept. But from the perspective of the lessee, we only have the concept of right to use the asset. There is no concept of operating lease actually. So lease is actually the right to control the asset has been transferred from the lessor to the lessee against some consideration. So this diagram actually tells you the definition of the lease act. Okay. What is lease under IAS 16? A contract is or contain a lease if it conveys the right to control. This is the most important point of the definition. The right to control the use of an identified asset for a period of time in exchange for some consideration. So there must be identified asset, there must be consideration, and there must be the right to control the asset in the lease agreement, and the overall concept is called leases. So moving towards the next slide. Yes. IFRS 16 permits two exemptions under IFRS 16. So we have two exemptions: the lease with the lease term. the leases with a lease term of 12 months or less. The lease with a lease term of 12 months or less will not be considered under IFRS 16. So the treatment of leases for the 12 months or less than period less than the 12 months is exempted under IFRS 16 actually, with no purchase option. Okay. Leases where the underlying asset has a low value applied on one by one basis. So like you can see here that if you are purchasing the chairs, if you are purchasing tables or a refrigerator for the office or a small amount of assets for a lease period of either less than 12 months or 12 months, or if the transaction period is more than 12 months, either if the value of the asset is lower. But what is the meaning of the lower value? So that it's a matter of professional judgment. IFRS 16 says that it's a matter of professional judgment. You have to identify by yourself that what are the assets which are having a lower value, and you are purchasing it. You are purchasing the right to control the asset under the lease terms. Then this will be exempted under the scope of IFRS 16. So what will be the treatment of these type of assets? So the simple treatment is the lease payment on a straight line basis should be charged as an expense. Okay. So these are two exemptions. Now, talking about, if you have some questions, you can ask. If you people have some questions about these three slides, you can ask it immediately, otherwise we have to move forward. Okay, please repeat this slide. I was just saying that under IFRS 16, we have two exemptions. Means the treatment of these two items should not be covered under IFRS 16. Even in substance, we have a lease arrangement. You can see in the arrangement that there is a lease, but it should be exempted from the scope of IFRS 16. So what are these assets? So if we are having a lease with a lease term of 12 months or less, and leases where the underlying asset has a low value. So these two types of assets are outside the scope of IFRS 16, and IFRS 16 just provides the hints about what to deal with, how to deal with these type of assets. If we are taking it on the lease terms, then the simple treatment is the lease payments on a straight line basis should be charged as an expense in the income statement. So the actual accounting treatment of IFRS 16 will not be applied on these two types of assets. Okay, so let's move on towards the next slide. If we buy a large amount of chairs, do we consider the value of the group of chairs as a whole or only the value of one chair? You have to consider each and every single asset separately. So if we are purchasing just one asset, then you can apply the accounting treatment of IFRS 16, but you have to, for the purpose of IFRS 16, you have to consider each and every asset on an individual basis. So on a one-to-one basis, if you are purchasing some chairs, so this will be outside the scope. If you buy a large amount, okay. one by one basis. Does it mean that if the lessee value is collective high but the asset have a low value individually? Yes. One by one basis means that we are not talking about that you are purchasing the assets in in the large quantity. You have to see the value of the asset on individual basis, that whether the value is significant according to the company's assets or insignificant. So let's start the basic accounting treatment by the lessee. At the commencement date, you have to recognize an asset, that is the right. So the name of the asset will be the right to use asset debit, and we have to recognize a lease liability. Like you can, if you remember IS 17, that previously we debited the asset and credited the finance lease obligation, and in the same way that we are right now we are here, we are debiting the right to use the asset and crediting the lease obligation. So the treatment is very much similar with the finance lease obligation. So there's a question that what is on another systematic basis? It depends actually. The depreciation and amortization that we charge is actually based on the pattern of the economic benefits that we extracted from the asset. So normally these type of assets provides the benefits on equal basis, therefore we charge it on the equal basis. But if you know that the asset will give you the benefit in the initial period more than the later period, then you have the more systematic basis for this will be that you have to charge the expense more in the initial period, and then so it's all about the concept matching principle that we use for systematic basis approach. Okay, so let's start. Right to use the asset debit and lease obligation will be credit. So these are the accounting entry that should have to be used for the lease, for all the leases in the books of lessee. So, but the exemption is the asset must be, the time period of the asset must be more than the 12 months, and the asset must be of significant value, high value items, or it should not be a low value asset. At the commencement date, the lessee should measure the right to use the asset at cost. Cost comprises of the present value of the lease payments, any lease payments made at or before the commencement of date, less any lease incentives. Lease payments made at or before means that if you are making some down payments for the lease, then it should also be included in the right to use the asset. Any initial direct costs incurred by the lessee, like some documentation or legal fees or something like that. Any dismantling costs incurred by the lessee. So these are all the costs that should have to be capitalized under the heading of right to use the asset. And the corresponding obligation will be recognized in the lease liability at the commencement date. The lease should be measured. The lessee should measure the lease liability at the present value of the lease payments that are not paid on that date. So the present value of the payments that we have that we have deferred in the lease agreement should be recorded at the present value. So all the lease payments that we have to pay in the future should be at the present value, and the difference will be sometimes the cash paid, or the difference will be actually the cash paid. For suppose the right to use the asset is debited by 100,000, but the corresponding lease obligation is now credited with the same amount, or it might be the shorter amount. So the difference will be the cash actually, which will be considered as a payment of initial down payment, or it could be the payment of initial direct cost. So in most of the cases, the right to use the asset and the lease obligation amount is approximately same. But if there is a difference, then it will be the cash amount. Now, what will be the subsequent treatment? For subsequent measurement, this right to use asset will be depreciated like we used under IS 16. So under IS 16, it could be placed for the cost model, or it could be placed at the revaluation model, or it could be measured under IS 40 if the asset is for investment purpose. So the measurement could be according to the provision of IS 16, that is the cost model or the revaluation model, or the measurement could be according to the provision of IS 40. So these are the basic key points. That we are using. Now we are moving towards the next slide. Yes, now the subsequent measurement. Accounting for any depreciation expense and accumulated depreciation impairment loss, if any, if the asset is owned at the end of the lease term. This is the most important point for the depreciation. If we are taking the asset and ultimately the asset's ownership will be transferred to the lessee at the end of the lease period, then asset should be depreciated at its useful life. And if the asset is not owned at the end of the lease term, then asset will be depreciated at the earlier of useful life and the lease period. So in which we have to depreciate the asset. So asset will be considered like we do the accounting treatment under IS 16. So the same accounting treatment will be applied, but for the depreciation there is a different rule, that if the ownership of the asset will be transferred to the lessee at the end of the lease period, then we have to depreciate at useful life. But if we have to return the asset in the future, then asset will be depreciated at the shorter of the useful life and the lease term. Now talking about the subsequent measurement. Okay, there is a question that the lease liability will always be the present value of the lease payments not paid at the measurement date. If the down payment, it will be treated as cash. Yes. If the assets stolen before end of the lease, what will be the treatment? Still we need to pay to the lease rental. Definitely you have to pay the lease rentals to the lessee, and the asset that you have lost will be dependent upon the insurance of the asset. So if the asset is insured, then there is no need to worry about anything. But if your asset is not insured, then you have to record a loss by crediting the value of the asset and debiting the cash. So after initial recognition, the lease liability is measured at the amortized cost. So you have to amortize the liability of the lease using the effective interest method. Each lease payment consists of the two elements. The one is the finance charge, and the second one is the principal amount, partial repayment of the liability. And the remaining liability should be broke up into current and non-current liability. So you have to break down the liability into current and non-current. So the simple accounting basic rules is apply to break the assets into current and non-current liability. And the simple way is, as you know, that if the liability is going to be settled in the next 12 months, then it will be considered as a current liability. And if the liability is going to take more than one accounting period from the balance sheet date, then it should be considered under non-current liability. So for the asset, you have to book the depreciation, and for the liability, you have to book what is the requirement? You have to book the finance cost, that is the interest element of the liability, and the remaining outstanding obligation after the installment payment will be broken down into current and non-current liability. So you have to present the liability and classify the liability into current and non-current section. So let's move on towards the next slide. So if you remember the basic accounting treatments of IFRS IS 17 finance lease, so you can see here that the treatment is very much similar. Okay, here is a question for you. A lessee enters into a 2 years lease of one floor of the building with an option to extend for further 5 years. So initially the lease period is 20 years and there is an option for the secondary period, that is for 5 years. The lease payments are 80,000 per year during the initial terms and 100,000 per year during the optional period. All the payable at the end of each year. To obtain the lease, the lessee incurred an initial direct cost of 25,000. At the commencement date, the lessee concluded that it is not reasonably certain that to exercise the option to extend the lease, and therefore determined that the lease term is 20 years. The interest rate implicit in the lease is 6%, and the present value of the lease payment is 917,600. At the commencement date, the lessee incurred the direct cost and measured the lease liability at 917,600. So what should be the accounting entry in the books of the lessee at the commencement of the lease? Please write the accounting entry on the chat box. What should be the accounting entry at the commencement of the lease? What should be the accounting entry at the commencement of the lease? At the inception of the lease. Please write your answers in the chat box. Right to use the asset debit. And what will be the credit impact? Please write your answers. In the chat box. Debit, right to use the asset. Cash credit, lease obligation credit. Yes. That's very good. We are receiving from a number of students the right answers. But try at least. Most of the students are, I think, hesitating and not writing their answers. There is no punishment or no penalty for writing the answers in the chat box. So please try to try to write your answers, whatever be your answers. So you have to participate in this type of process. So it's very useful. It will improve your confidence. So let's start. So the right entry will be right to use the asset, debit by 917,600 plus 25,000. This is actually the initial direct cost. That should also be capitalized. The lease liability should be recorded with 917,600 and the remaining amount will be credited in the cash account. That is, we have paid the initial direct cost of 25,000. Now, the second point is whether we should have to depreciate the asset over 25 years or 20 years. Whether we should have to depreciate the asset over 25 years or 20 years. Optional period should be included in the lease term. Yes, the most important point is that the asset should be depreciated over 20 years. The secondary period, that is for the 5 years, will only be included in the lease term when it is highly probable, that the lessee will exercise the secondary period and enjoy the use of the asset or control the asset over 25 years. So you can see here at the commencement date, the lessee concluded that it is not reasonably certain to exercise the option to extend the lease. Therefore, we are using the lease period of 20 years. But if this line is not given in the question, then we have to depreciate the asset over 25 years. So this is a very important point for the depreciation. So what should be the depreciation of this asset? So it will be 942,600 divided by 20. So what is the right answer for this? Yes, the right answer is 471,30. Okay. So let's move on towards the next slide. So for this question, all of you are required to solve this question on the table. This is actually the amortization table for the lease liability. Lease liability. So please try to prepare the amortization table and tell me what amount should be recognized in the income statement at the end of year 1 and 2. So for year 1 and 2, what amount should be charged in the income statement and in the balance sheet? So all of you are required to please solve. And okay, let's start. The obligation at start should be 917,600. The interest should be charged at the 6% rate. So amount of the interest should be, here is my calculator. It's 917,600.06. We got the value of 55,000 056. The payment for the first period, that is the rental, is 80,000. So 917,600 plus 55,056 minus 80,000. So we got the value of 89,892,656. So for the second year, 892,656 will be the obligation at start into 0.06. 0.06 89,892,656. We got the value of 53,559. Again, we have got the payment of 80,000 plus 892 minus 80,000. The value will be 866,215. Then year 3, the value it's 866,215. Then we have to take 0.06% of this again. The amount of it will be 519,73 plus 866,215, 80,000. The amount will be 838,187. Yes, any question from this table? Okay, it's fine, I think. Okay, so for the first year, year 1, the finance cost component should be 55,056, and depreciation will be, we have calculated depreciation, that is 471,30. Then for the balance sheet, the right to use the asset is 942,600 minus 47130, and the lease obligation will be broken down into current and non-current liability. So the final total amount of the liability is 892,656. So the non-current portion will be 866,215, which is still outstanding for the next year, and the current liability will be 892,656 minus 866,215. So this is the amount that we have paid, and this is the amount that will be paid after 1 year. So this is how we have solved the question and calculate the value of finance cost, depreciation, right to use the asset, and non-current and current liability for the first year. For the second year, the finance cost is now 53,559. Depreciation will remain the same as we are following the straight line basis. Asset will be depreciated further for 47130, and the current and non-current liability will be broken down from 866,215. So this is how we have solved the lease question. So I think it's very simple and very much easy to understandable and very much similar to IAS 17 calculations. So if you have any question, you can ask it immediately. Otherwise, we have to move forward. How we have identified 55,000. Actually, when we are following the amortization table, the interest rate should be applied on the obligation at the start of the period. So the rate of the interest implicit in the lease is 6%. So we have taken the 6% amount of the obligation at start, that is 917,600. This is how we have calculated 55,056. Any other question? Okay, no question. So we are moving towards the next slide. Now here we have the next slide, that is reassessment and remeasurement of the lease liability. After the commencement date, the lessee should remeasure the lease liability. If any changes occurs using either the unchanged discount rate or the revised discount rate to reflect the changes in the lease payments. So actually the lease payments is based on some assumptions and some factors, and if the factors have gone changed, then this should be adjusted. This is the requirement of IFRS 16, so that you have a true and the fair value of the liability. A lessee should account for the remeasurement of the lease liability as an adjustment to the right to use the asset. So there must be a remeasurement of the lease liability as an adjustment to the right to use the asset to the extent it covers the right to use the asset, and the remaining amount will be recognized in P&L. So if the adjustments is more than the value of the right to use the asset, then the excess amount will be recognized in the income statement. So these are the requirements. Now initial measurement. Accounting for the lease by the lessor. Initial measurement at the commencement. Now the lessor will recognize the same operating and the finance lease concept as we have previously under IAS 17, and the classification will depend upon the risk and rewards and the criteria that is called the finance lease indicators of IAS 17. So do you people still remember the finance lease indicators of IAS 17? Do you have the idea that what are the finance lease indicators under IAS 17? Yes or no? Is it yes or no? No, that's very good. Be honest. So the one of the point is that when the present value of the minimum lease payments is approximately equal to the fair value of the asset, then it will be considered as a finance lease indicator. But if the present value of the minimum lease payment is less than the fair value of the asset, then it will be considered as an operating lease. The first criteria is here. The second one is when the lease period is for the major part of the asset's economic life. So if the lease period covers the major part of the asset economic life, then it will be a finance lease. But if the lease period covers the minor part of the asset economic life, then it will be an operating lease. Third one is the lease contains the bargain purchase option. And it is highly probable and it is probable that the option will be exercised. Then it will be a finance lease. And if the lease does not have any bargain purchase option, then it will be considered as an operating lease. So any criteria, if there is any single criteria which have been met, then it will be considered as a finance lease. It's not necessary that for all of the criteria should have to be met at the same time. If any single criteria is met, then it will be considered as a finance lease. Otherwise, it should be classified as an operating lease. The next criteria is when the asset is of specialized nature. Then it will be considered as a finance lease. And finally, when the risk and rewards of ownership has been transferred from the lessor to the lessee at the end of the lease period. So if these criteria are met, then it should be classified under finance lease. If all the criteria are not met, then it will be considered as an operating lease. So the remaining lease will be considered as an operating lease. Now, what are the accounting treatments? In the books of lessor, in finance lease, the lessor does not record the lease asset in its financial statement as it has transferred the risk and rewards. Instead, he records the amount of the receivables, that is net investment in the lease, with the fair value or the present value of the future cash flows plus initial indirect cost. So the debit entry should be net investment in the lease, debit, and asset credit. When the company has transferred the asset under finance lease. But when the company has transferred the asset under operating lease, then the lessor record the lease asset in its financial statements and has not transferred the risk and reward of the ownership. At the commencement of the lessor adds initial direct costs incurred by the lessor. So the accounting entry for the amount that we receive under operating lease will be cash debit and credit will be the income. So the income should be recognized under operating lease. So it's like you have given your asset on a rental basis to someone. So the amount that you are receiving will be the rental income. So let's move on towards the next slide. There is a request for the break for the 5 minutes. I think it's a prayer time. So if you need a prayers break, then I can give you the break. So someone wants to offer the prayers. Okay. So I'm giving you the break for the prayers. So let's take a break for 5 minutes. Okay, welcome back. So let's start the session again. So these are the requirements under I-17. Now these are the adjustments when we subsequently receive the payments. So the accounting entry will be debit cash and credit net investment in the lease. And subsequently when we charge the finance income, the accounting entry will be net investment debit and finance income credit. For operating lease, the subsequent measurement will be lessor requires the depreciation expense. The policy must be consistent with the lessor's policy. The accounting for any impairment loss records the rental income on a straight line basis over the lease term. So the accounting entry and the treatment for the lessor is very simple. Here we have the accounting treatment for the manufacturer or the dealer. Can they ask about the operating lease in the exam? Yes, examiner can ask about the operating lease because the accounting for the operating lease is still under the scope of IFRS 16 from the perspective of the lessor, but it's not available from the perspective of the lessee. Okay, now we have the accounting treatment for lessee by the lessor. Accounting treatment of lease by the lessor. When there is a manufacturer or dealer, when the lessor is actually the manufacturer or the leader, like if the company, Toyota company or the Honda company was the manufacturer of the product, and at the same time they sell their cars on the lease terms, then it will be the manufacturer, the dealer lease. So for the manufacturer dealer, the key point is that when we sell the asset, it will be my sales. Therefore, you have to record the lease receivable debit and credit the sales. But if the leasing company is giving the asset under the lease term, then this will not be considered as the sales of the leasing company. So what they do, they credit the recognized asset and debit the lease investment. But from the manufacturer, the dealer's perspective, it should be receivables debit and sales credit, lower of the fair value and the present value of the lease payments. So the accounting entry should be from this amount. Then asset that will be placed in the inventory should be charged in the cost of goods sold. So the cost of goods sold debit and inventory credit, and the unguaranteed amount which is not actually going to receive by the lessor from any party, so it will also be charged in the receivables. So the accounting entry will be credit inventory and debit lease receivables. Then we have to expense out the initial direct cost, that is statement of comprehensive income, that is income statement debit, and cash or bank credit. And subsequently we recognize the lease income by debiting the lease receivables and crediting the income statement. So this will be the accounting entry for record the finance income subsequently. So these are the entries and the treatments under. Now Accounting for the lease by the lessor, manufacturer or dealer when the asset was given on the operating lease terms. So the initial measurement does not record any sales, record the asset by debiting the asset and credit the inventory, then record the depreciation, record the impairment loss, and record the rental income. So very simple treatment for manufacturer, dealer, lessor, but it's highly unlikely that there will be any company who is selling or giving the assets, who is the manufacturer, the dealer, on operating lease. Because if I'm the manufacturer, I have to sell my inventory rather than giving the assets to the different companies and different businesses on a rental basis. So it is highly unlikely that this type of transaction will take place in practice. But we have the accounting treatments. Now there's sale and leaseback. This is one of the most important area that examiner can explain, examiner can ask. Okay, there are some questions from the student side. That the first one is, what is unguaranteed residual value? Unguaranteed residual value is actually the part of the residual value which is not guaranteed to the lessor by any party. Please do explain the impairment in the case. Impairment means that when we are recognizing the asset, then it will be considered under IAS 16 and we have to book the impairment according to the provision of IAS 36. So when the asset is placed under IAS 16, impairment will be considered under IAS 36. That is, when the carrying amount is greater than the recoverable amount, then the difference will be recognized as an impairment. Okay. There are another question from the sir, under the operating lease, the lessor and the lessee both charges the depreciation. Under the operating lease, both charge a depreciation. Now this is a very important question, that in this case, if the lease period is more than 12 months, then yes, both parties are recognizing the asset and charging the depreciation. But the basic difference is that if I have got the asset, like I have got the car, so I am charging the depreciation of the car actually. But to the party which I have given the asset, they are charging actual depreciation for the right that they have acquired. So they have booked the right to use the asset rather than the car actually. So the car is my asset and I have to depreciate the car, but the lessee has acquired the right to use and control that car. So they are depreciating actually not the car, they are depreciating the right actually, which they are charging. Okay. Sale and leaseback transaction involves one entity selling an asset to another entity. Now this is a very unique concept, that one entity sell the assets to another entity and then lease back the asset. That's very important. This type of transactions normally take place with the financing companies or with the leasing companies, and these type of transactions occur when the company is facing some liquidity issues. So they sell their assets major and then lease back their assets. The sale and leaseback transaction involve one entity selling an asset to another entity and then immediately leasing it back. The main purpose is to allow the entity is to release the cash that is tied up in the asset. So this is a very important point. Accounting for the sale and leaseback depends on whether the transfer is a sale or not a sale. So when we can say that the transfer is a sale, then when you can say that the transfer is a sale according to the provision of IFRS 15. When you can say that the risk and rewards of ownership of the asset has been transferred from one party to another party, then we can recognize the sale. But when the transaction in which there is no sale according to the provision of IFRS 15, then there is some different accounting treatments. So the accounting treatment of the sale and leaseback will clearly depends upon whether there is a sale in the transaction and whether there is not a sale in the transaction. So let's discuss some provisions further. Okay. This is the most important point, and I think examiner can ask question from this part. Okay. Sale and leaseback. Like I am going to sell the asset to my customer, that is B. So B is actually the buyer and A is actually the seller, and I have taken the asset back on the lease terms. So actually B is the lessor. At the same time B is the buyer actually and B is the lessor. And A is the seller. At the same time A is the lessee. Okay. So A is actually the seller and A is actually the lessee. If the transfer of an asset by the seller lessee satisfy the requirement of IFRS 15, then the lessee shall de-recognize the carrying value of the asset and recognize the gain or loss. Gain or loss is normally calculated as the difference between the carrying amount and the fair value. Like if I have sold my asset with a value of 4 to the buyer at a value of 6, then I have recognized a gain of 2 million. So I have realized a gain of 2 million. And in the same way, there might be a loss in the transaction. Now, but the key point is you have to multiply this gain with the fair value minus the present value of the future cash flows divided by the fair value. Now what is this? Fair value minus the present value divided by the fair value. And you have to take the percentage of that. You have to multiply this with the gain amount. So here we can see that there is a gain of 2 million. So the fair value is now 6 million. You can see that I have sold my asset with a value of 4 million at a value of 6 million. Assuming that the present value of the future cash flow of the asset is assuming that it is 5 million. So 6 minus 5 upon 6, there will be a percentage of 6 minus 5, 1 divided by 6, that is 16%. Effectively 17%. So the key point is that we have sold the asset, lessor has sold the asset to the lessee. Okay, sorry, the seller has sold the asset to the buyer and leased back the asset. So the asset has gone from the seller to the buyer, and through the lease we have taken back the asset, but we are now have the right to use the asset. Okay, and we are multiplying this by fair value minus present value divided by fair value. So the portion of the asset which have actually sold, this portion of the gain can be recognized. So you can say that we have sold actually 17% value, 17% of the asset, because we have sold the asset and then we'll lease back the asset. So there is some portion of the asset that we have actually sold. So actually we have retained the 83% of the asset and we have sold actually the 17% of the asset. So according to the new standard, you can only recognize that portion of the gain or loss that you have realized and for which you have sold the portion. So you can say that we have sold actually 83% of the asset. Sorry, we have sold 17% of the asset. The asset has already been retained by the company through the sale and lease back. So you can only recognize the portion of the asset that we have sold. So you have to calculate the percentage of the asset that we have sold. So the fair value minus the present value of the minimum lease payments divided by the fair value. This is how we can calculate the gain or loss. So are you people getting this point? Please write yes in the check box if the point is clear. And if you have any question, then please do ask. Please explain with example. I have given the example. Clear? CLC means? Okay, next, let's move on. Towards the next part. If the transfer of an asset by the seller, lessee, satisfy the requirement of IFRS 15, then the lessor shall account for the purchase of an asset according to IAS 16 and treat it as an operating lease according to IFRS 16. So what the buyer should have to do? Buyer should have to debit the asset and credit the cash, and debit the depreciation expense and credit the accumulated depreciation, and then cash debit and rental income credit. So the accounting treatment for the buyer is very simple. Now, here is another challenge. When the sales price is above the fair value, when the sales price is above the fair value means that the sales price is 10 million, but the fair value of this asset is suppose 9 million. So actually I'm going to sell the asset, the fair value of 9 million for 10 million. Yes, there is a question then. When we are why we recognize a portion of the gain instead of full gain when we actually sell the asset? Yes, we have sold the asset actually, but we still have got the right to use or control the asset. So actually the risk and rewards of the asset has not yet transferred from the seller to the buyer. So we have sold the asset, but we can only recognize the portion of the asset that we still have retained. That portion we cannot recognize. We can only recognize the portion of the asset that we have sold actually. So there is a dispute between my thinking and the treatment of IFRS 16 that it's my opinion that we should have to recognize the full gain because the sales has occurred and the risk and rewards has been transferred. And we are just using the asset for a limited time period. So it's my opinion that the gain should be recognized in full. But as you can see that here we have to follow the provisions of this IFRS. It's a new standard. So there might be some adjustment you can see in the future. So currently we have to study this portion and we have to memorize and understand this portion. So it is somehow, I think it's illogical to recognize the portion of the gain. Okay, sale above the fair value. If the sale proceeds are above the fair value, the difference between the sale proceeds and the fair value shall be treated as a financing provided by the buyer. So assuming that if the carrying amount is also 9 and the fair value is also 9 and we are selling the asset for 10 million. So the accounting entry should be debit cash by 10 million, crediting the asset by 9 million, that is actually equal to the fair value, and also crediting the liability. This one is called the financing component, which is 1 million. So it is not actually possible to sell the asset above the fair value, but if there is a sale, some time of sales in which you can see that the sales price is above the fair value, that it shows that there might be some adjustments between the seller and the buyer, that I have to take the asset back on the lease terms. So right now I'm giving you the favor, but you have to give me the favor in the rentals. So there will be an adjustment between the two parties when the sales price is above the fair value. It means there will be a relaxation in the value of the rentals in the future. So we can say that we have to recognize a liability that will be considered as a financing component. Explain this sale and leaseback by an example. It will be easy to understand by the example. Okay, I will give you some examples. Then for this one also you have to calculate the gain or loss. That gain or loss will also be based on the proportionate basis. So the fair value minus carrying amount, and the difference will be the portion. So let's take an example. Okay, let's take an example. That company A sold its asset to company B that has a carrying value of 10 million. Okay. then lease back the same asset under an lease arrangement. The sales price is assuming 15 million. Okay. So definitely when we have to take the asset on the lease terms, the fair value will be 15 million. But the present value of the future payments might be approximately equal to the fair value, or it could be lower than the fair value. So assuming that the future present value of the future cash flows is also equivalent to 15 million. So what does it means? You can see that on the sale there is a gain of 15 minus 10. So there is a gain of actually 5 million. So what portion of the gain can be recognized by the seller? So you can see here that an asset with a fair value 15 was sold to B, and we have taken the same asset with the right to use the asset, and the present value of the future cash flows is also 5. It means 15. It means that the full amount, which is the equivalent to the fair value of the asset, has been paid by A to B, by the lessee to the lessor, which shows and which means that I have not actually transferred my asset to B. So I'm just giving them the asset and taking the asset back. So the gain that should have to be recognized will be fair value, that is 15. Sorry, it's 15 minus the present value of the future cash flow, it is also 15, divided by 15, you got the value of 0. So you cannot recognize a single gain because we have transferred the asset and the same amount of the asset has been transferred by the seller to again from the buyer. Actually, this one is the lessor and this one is the lessee. So seller has sold the asset at a particular value to the buyer, who is the lessor, and lessor has given the asset to the lessee with the same value. So actually you have not yet transferred the asset and you cannot recognize the gain. But taking another case, if the present value of the future cash flows, assuming, is 5 million, assuming, that means that we have sold the major portion of the asset and retained the minor portion of the asset. So now you can recognize the gain to some extent. To what extent? There is a gain of 5 and you have sold 15 minus 5 divided by 15. So there will be 10. So the 10 million value of the asset was sold by you out of 15. So what portion we have sold to outside the group, outside parties, or you can say the lessor, that is 67% approximately. So now you can recognize 5 into 67%. So actually IFRS 15 is saying that the portion of the asset that you sold to the lessor should be recognized as a gain. But the portion that you have still retained, you cannot recognize the gain for that portion. So here you can see that we have sold the asset for 15 and retained the 15 million value. It means we have retained the full asset. So if you have retained the full asset, it means we cannot recognize the gain. In this case, you can see that we have sold 10 out of 15 value. It means we have sold 67% asset. So we have retained only 13% of the asset. So we can recognize 67% gain of 5 million. I hope I have cleared the points. Please, sorry, 33, sorry. It is 33. Okay, next, move on towards the next slide. Oh, another case. If the sales value is below the fair value, lessees, the present value of the future cash flow affect the lessee. Yes, I didn't get the question. Please repeat your question. Okay, the sale price is below the fair value, means that the sales price is assuming 10, but the fair value of the asset is, suppose, 12 million. So you are selling your asset with a value of 12 million for just 10 million. Okay. If the sale proceeds are below the fair value, the difference between the sale proceeds and fair value should be treated as a prepayments. Okay. So what should be the accounting entry? If I'm going to sell my asset, the accounting entry will be cash debit for 10 million and asset credit, assuming the carrying amount of the asset is 12. So the difference will be 2 million will be considered as a prepayment. The entity shall make the following adjustments other than the remaining the same. Record the lease liability at the present value of the lease payments. Right to use the asset as a carrying amount into the total present value of the lease payments divided by fair value. And the gain or loss will also be recognized on proportionate basis. So if there is a gain between the fair value and the carrying amount, so that gain will only be recognized to the extent of the proportion of the asset that we have sold. So these are actually, okay, the present value of the future cash flows is what is the lessee is getting from the leasing the asset. The lessee, present value of the future cash flows means the amount of the payment that the lessee is required to pay under the lease term. So the overall payment that the lessee should have to pay to the lessor will be discounted and taking the present value. So this will be considered as so there are some questions in the exam kit. So I would recommend you, because of some time limitation, I would recommend you to please do attempt these questions in the exam so that you will be able to understand it further. And if you have any confusions, you can ask it immediately on the WhatsApp group. I will provide you the support till December. So don't worry about the P2 exams. Just do the questions. If you are confused in anything, just take the picture of that question. Right nowadays, I am very slow in replying till 10th of November because of some major commitments of this prepare to pass session, and I have some other commitments as well. But from Saturday onwards, I'll be free, so you can message me, and I will reply all the reply the emails and at the same time I will be able to reply all the questions on the WhatsApp as well. So even you can discuss within the group as well, and even you can ask questions directly to me. So there is another challenge. When the transfer is not a sale, when the transfer is not a sale, I think this part of the question has a high chances to be examined. When the transfer is not a sale for the lessee and the lessor. If the transfer of an asset by the seller, the lessee does not satisfy the requirement of IFRS 15, then the lessor shall continue to recognize the transfer asset. Shall recognize the financial liability equal to the transferred proceeds in accordance with IFRS 9. So here we can see that there is an implication of IFRS 9. So you have to book a financial liability when there is no sale. So the amount that you actually receive from the sale will be your financial liability. The lease amortization schedule will be needed for the principal interest charge over the lease term. So interest charges debit, lease liability debit, and cash credit will be the accounting entries that you shall have to make. For the buyers, if the lessee has an asset but the seller does not certify, okay, same. So we have to recognize a financial asset for this. The lease amortization schedule will be needed to the principal, and so accounting treatment is quite simple as compared to when the transfer is a sale transaction. So I think there is a high chances that examiner can ask the question from this part. So you have to identify and memorize this point, whether there is a sale or not. Yes, here is a question for you. I'm giving you just 2 minutes to solve this question. 2 minutes. Please write your entries so that we can discuss this question. Okay, I'm back. I hope you people have solved already this question. Now here you can see that the fair value of the building is 4.5. Okay, million. The carrying amount is 3.5 and the sale proceeds is 5 million. So you can see that the sale proceed is above the fair value. So what are the requirements of the standards? That when the sale proceed is above the fair value, you have to book the financing component. Secondly, whether there is a sale or not, the terms and conditions of the transaction such that the transfer of the building X satisfy the requirements to determine whether performance obligation is satisfied. When a performance obligation is satisfied, the revenue from the okay. The terms and conditions of the transaction are such that the transfer of the building by X satisfies the requirement for determining the performance obligation. So you can see that there is a sale transaction and the sales price is above the fair value. So for the convenience, I have to go back. This case is the sale price is below the fair value. You have to come back here. When the sale and lease back, and we are talking about for in the books of the seller or the lessee. Yes, the sales price is above the fair value. We have to discuss this point again so that you will be able to get the understanding very easy. If the sales proceeds are above the fair value, the difference between the sale proceeds and the fair value shall be treated as a financing component. So the sales price here is 5 million and the fair value is 4.5 million. So there is a financing component of 0.5. Agreed? By the buyer lesser. Sales minus the fair value. So that's very simple. The entity should make the following adjustments, others remaining the same as above. Record the lease liability at the present value of the lease payments, including additional financing. Right to use the asset as the carrying value into the net present value. Now there is a concept of net present value here. It's not about the present value, it includes the net present value with the lease payments net of additional financing divided by the fair value. So the formula for the gains and losses will be fair value minus carrying amount. You will find a gain here. Carrying amount is 3 million, I think, and fair value is 4.5. So there will be a gain of 1.5. But you have to take the proportion by fair value minus net present value divided by the fair value. So what is the net present value actually? Is the lease payments net of additional financing. Okay. So these are the requirements. So I have to go back. Yes. Here you can see that the carrying amount is 3.5. So the gain will be fair value minus carrying amount. And you have to multiply this by fair value minus net present value divided by fair value. So the fair value is right now, what is the fair value? That is 4.5 and the carrying amount is actually 3.5. So there will be a gain of 1 million. Now you have to take the proportionate value. So the fair value is given to us, that is 4.5. all you need to do is to calculate the net present value. So for net present value, you have to take, there is an annual payments of 200,000 on an annual basis. So 200,000 for after year 1, 200,000 after year 2, and then 200,000 till 20 years. So all of you are required to calculate the present value for the 20 years. So here we can use the formula for the annuity factor, that is 1 plus I minus 20, 1 minus I divided by I. If you remember the formula for the annuity, this one is actually, so 1 minus into 200,000. So please calculate the value and give your answer. 1 plus 0.0605 to the power minus 20 divided by 0.05. I think present value will be 2492. 24, where is the value? It's 2492400. Two four nine two four double zero. So in a simple terms, you can say that there is the value of 2.5 million actually, and net of, there will be a net of present value concept. So 2.5 minus the financing component is 0.5, then you will get the value of 2 million. So 4.5 minus 2 divided by 4.5, we get the value of 55%. Into 1, you can book the gain, of 0.556. I'm very sorry. So now what should be the accounting entry? We have to debit the cash by 5 million. Okay. We have to credit the financing component, that is the liability, that is 0.5. You have to credit the asset, the value of 3.5. And then there will be a credit amount in 0.55. This is actually charged in the income statement. So what about the difference? 5 minus 4.556, 1 minus 0.556. The portion that we have not yet recognized will be recognized as a deferred income, 0.44. So this is how we have to balance and recognize the entry at the time of the sale. So I think we should have to take a break. If you want, there is a need of the break from the student side for further 5 minutes for the prayers. So we can take the break for the 5 minutes. Then we'll start the next topic, that is financial instruments. That is 5 minutes break. Okay, welcome back. Let's start. Busy sending error. Okay, financial instruments. Starting from the first slide. Yes, financial assets. The requirement for the financial assets is that all the financial assets should initially be recognized at fair value plus transaction cost. But if the case is the financial asset is measured at fair value through P&L category, in this case, the transaction cost should be charged in the income statement as an expense. But if the financial asset is measured at amortized cost or through OCI, then both the cases you have to capitalize the transaction cost. So initially recorded at the fair value, it should be fair value. Subsequently measured at the fair value changes taken to the OCI, interest, dividend, gain or loss, disposal to P&L. For this category, initially recognized at the fair value, subsequent measurement at the fair value changes to the P&L, interest, dividend will be P&L. And for this category, initially recognition at fair value plus transaction cost, subsequently amortized over the time period. This is actually the classification for financial asset. We have three categories in which we can classify the financial assets. For equity instruments, we only have two categories. That is the fair value through P&L and fair value through OCI. Now it all depends upon the company, that where the company wanted to transfer its equity instruments. It could be placed at the fair value through P&L and it could be placed at fair value through OCI. But if the equity instruments were placed at fair value through OCI, it cannot be reclassified into fair value through P&L. So you can say that this option is an irrevocable option. Okay. Secondly, held for trading. As financial assets of equity instrument will always be classified into fair value through P&L. So fair value through P&L is actually a default category in which we can place any type of equity instruments, but held for trading will only be classified in fair value through P&L. All financial assets and equity instruments are initially measured at fair value. Yes, initially all the financial assets should be measured at the fair value. Then if we wanted to classify our equity instruments into fair value through OCI category, then you have the option that this option is irrevocable and the asset should not be held for trading purpose. Okay. Now for the debt instruments, we have all these three categories: fair value through P&L, amortized cost, and fair value through OCI. So debt instruments can be placed at fair value through P&L and fair value through OCI. There is a question that if the equity instrument is unquoted. Yes, if you remember the day 4 session that we have discussed about the IFRS 13 fair valuation measurement. So how to calculate the fair value. So for quoted companies, we take the market value. For unquoted companies, we take input level 2 approach to calculate the fair value. Okay. Then to place the debt instruments at amortized cost, there must be two tests, that is the business model test and the cash flow test. That should have to be passed before placing the debt instrument into amortized cost category. So business model test will be passed when the intention is to hold the debt instrument up to the maturity. For debt instruments, all three are valid. All three, which three? Which three you are talking about? Okay. For amortized cost, we can place the debt instruments into amortized cost, but there must be two tests that should have to be passed. First one is the business model test. Second one is the cash flow test. Business model test will be passed when the intention is to hold the debt instrument up to maturity. And cash flow test will be passed when the cash flows will be based on interest component and principal component. So if your future cash flows are totally based on interest and principals, nothing else, then it means that your cash flow test is passed. So if both the tests are passed, then you can place the financial asset under amortized cost, in which initially you have to measure it at amortized fair value, and subsequently it should be amortized. There is no fair valuation adjustment under amortized cost method. Now for the fair value through OCI category, we can place the financial asset into fair value through OCI category, but there is also two tests, that is the business model test and the cash flow test. So the names are the same, but the cash flow test of both amortized cost and fair value model are same. It means your cash flow should be based on the principal and your cash flow should be based on the interest amount. But the business model test is slightly different. The intention should be to hold and sell. So if the intention is to hold the financial asset and to sell it subsequently, then it should be classified in fair value through OCI. And if both the test of both the models are failed, then the remaining will be classified in fair value through P&L category. So for debt instrument, it is actually the remaining category in which you have to place the fair value through P&L. So if the debt instruments fails to classify into amortized cost and fair value through OCI, then it should be classified into fair value through P&L. Okay, all three means through P&L, amortized cost and OCI. Yes, all three are available for the debt instruments, but only two categories are available for the equity instruments. Okay. So one option is amortized cost, second option is fair value through OCI. For these two options, you have to pass the test. And the third one is the residual instruments will be classified into fair value through P&L. But for the equity instrument, you have the option, either you can place the equity instrument into fair value through P&L or it could be an OCI. But normally, when the company has the intention to hold the shares for long term, it usually classify the shares into fair value through OCI category. So this is how the treatments of financial instruments should be look like. Here is a question for you. The company has purchased the loan notes. Purchase the loan notes means we have got the financial asset, that is a debt instruments. That is the financial asset. And you know it is valued, it should be measured at the amortized cost, means the business model test and the cash flow test is passed already. Now how we can recognize the financial assets? So for amortization, for amortized cost, there must be an amortization table for the year 1. For the year 1, there must be the financial asset at the start. Then we have interest income. Then we have the receipts. And then we have finally the financial asset at the end. So the loan has a par value of 100, discount is 12, transaction cost is 2, premium is 3.92, 4 years maturity, and effective rate is 10%. So how we can measure this? Financial asset should be measured at the fair value plus the transaction cost minus, you have seen that there is a discount, that will be 12. So 100 plus 2 minus 12, it should be valued at the 90 at the start. So the financial asset at the start is 90. Then we have to charge the interest at the 10%, that will be 9. And the receipt will be 100 into 6, that should be based on the nominal value. So 100 into 6 means it will be 6, I think. So the financial asset at the end of the period will be 93. Then for year 2 it will be 93 into 10%, that will be 9.3, then 6 will be the receipt, and we have got the financial asset at the end, that is 93 plus 3.3. It will be 96.3. This is how we measure the financial asset at amortized cost. Default position for that instrument is fair value through P&L? No. Default position is not fair value through P&L. It is actually the default position for the financial asset of the debt instrument is not given. You have to place it on the basis of it is actually the default position is amortized cost for the financial liabilities, but for the debt instrument it could be fair value through P&L, but for the debt instrument it depends upon the test that should have to be passed. Explain 90. Okay, 90, we have to book the financial asset by deducting the discount and by adding the transaction cost, because there is a discount in the instrument, that is 12. So therefore we have to adjust the discount. What discount? 12. Yes, 6% is payable per year. Where did the 6 comes from? Okay. Here's another question for you for the financial liability. So what you are required to do, you have to record the obligation at start plus interest minus payments is equals to obligation at end. The calculation is approximately same. For both the parties, but the issuer will recognize it as a liability, but the investor will recognize it as a financial asset. So the par value of the interest minus issue cost minus discount should have to be deducted from here. Then interest will be based on the effective rate. The payments will be based on the rate at the par value, and we got the financial obligation at end. So please try to solve this question by yourself. I'm giving you 1 minute. Okay, let's start. Year 1, the obligation at start should be the par value, that is 100, minus discount, that is 7, and the transaction cost, that is the issue cost, should be 3. So initially it should have to be recognized at the value of 90. Then we have to take the interest, that is 10%. That would be 9. The payment will be 5%. That is 5. We got the obligation at end. That will be 94. So this amount will be shown in the liability area. This will be my finance cost. For a financial assets, transaction cost should be added in the value of the asset, and for a financial liability, it should be adjusted against the obligation. That is the requirement of financial instrument. Explain the difference between the issuing and the purchasing the loan notes. If you are purchasing the loan notes, means you are investing in the loan notes, in which it means that you are providing the loan. So the instruments that you take by providing the loan will be your asset, and issuing the loan notes means that you are taking the loan and the loan amount will be your liability. When should we discount? Actually, the discount occurs because of the changes in the market rate. So if you have a loan instrument that having a particular interest rate, and if the market rate of the interest differ from the rate that is being issued, and or you have the loan with a particular rate, so if the market rate of interest differs from the rate that is provided to you, then there will be a discount or premium concept. So you have to issue your loan at a discount when the interest rates of the market goes up. But when there is a decrease in the interest rate, then will be a concept of premium. Okay. Let's move on towards the next slide. There is another concept of compound instrument under financial instruments. The first one is compound instrument is an instrument which has both the equity and the debt component. What will be the accounting procedure? The compound instrument should be broken down into financial liability and equity. So how we distribute between the amount between the financial liability and equity? We take the present value of the future cash flows discounted at the market rate of simple loan, and the remaining difference balancing figure will be the equity component. Okay. What's next? The transaction cost. If there's a transaction cost, then it should be adjusted against the liability and the equity respectively. But you have to calculate the transaction cost of the instrument in the same proportion as we have in the above entry. Like suppose we have debited the bank account by 100, crediting the financial liability by 80 and crediting the equity by 20. Then it means in the total instrument 80% is the weightage of the liability and 20% is the weightage of the equity. So the transaction cost should be distributed in the same proportion. So according to IS 32, the transaction cost of the liability should be adjusted against the liability and the transaction cost of the equity should be adjusted against the equity. So these are some basic points. Let's have a question for you. I'm giving you the question. Please solve it by yourself. You are required to calculate the present value of the liability. You are required to calculate the present value of the liability. Okay, let's start. We have 3 years for the loan. The conversion rate, the convertible loan having the rate of 10%. So the interest rate for the first year will be 6, second year will be 6, and the third year will be 106. That is the interest plus the capital amount. The simple rate of the market rate of the simple loan without conversion option is 9%. So the first year the factor will be 0.917. For the second year it will be 0.841. For the third year it will be 0.772. 0.772. So 6 multiplied by 0.917, we got the value of 5.5. Sometimes it's difficult to write it on the table. With 6 multiplied by 0.841, it will be 5.05 approx. For the third year it will be 106 into 0.772. It will be 82 approximately. So the present value will be 82 plus 5.5 plus 5 approximately. We got the value of 92.5 approx. That is the PV of liability. So what should be the accounting entry for this loan? The cash should be debited by 100. Liability should be credited by 92.5, and the difference will be recognized in equity, that is 7.5. So as you can see that the amount is 100 million, so it's very easy to calculate the percentage. You can see that it's 92.5% for the liability and 7.5% for the equity. So we have to adjust the transaction cost in the same manner than that the amount of the transaction cost should be adjusted against the liability portion will be 0.925, and for the liability portion it will be 0.075. So the revised liability is now 92.5 minus 0.925. That will be 91.57, and the equity portion should be 7.5 minus 0.075. It's 7.4 actually. So if you have any question in this part, you can ask it immediately. How 0.917? It's the discount rate for the first year for 9%. Yes. What is the maturity? What if the maturity loan notes is not converted to equity? Then what is the treatment of the equity element at the end? Okay, the equity element at the end will remain the same actually, and it will remain in the equity, or you can transfer the amount into another component of equity. But if the holder of the convertible loan did not exercise the option, it will remain the same. So there is no. Okay, so we are moving on. For the first year, the obligation at the start will be 91.57. Then we have to book the interest or the finance cost. It should be now the effective rate, that is adjusted rate, that is 9.38%. minus the payments. You got the value of obligation at end. So 91.57 into 0.0938. There is an interest of approximately 8.6, and the payment, as you know, it's 6. So the value will be 91.57 plus 8.6 minus obligation at 10. There's a error, that is 91.57, 8.6 minus 6. We got the value of 94.17. It's 94.17. Okay, so this amount should be reported in the liability section. This is my finance cost, and the equity section, there is an equity option of 7.42. Any question from this side, from this part of the question? 191.57 and not 92.5. Actually 91.57 is now the adjusted amount of the liabilities. So 92.5 is the amount before the transaction cost. So you have to amortize by deducting the transaction cost in the discount first, then you can amortize the loan amount. What percentage did you use for 0.917? 9%. You can take the discount factor of 9% for the first year. You can easily calculate this by dividing 1 divided by 1.09. 1 divided by 1.09. Should I have to move forward? I think we are already running out of time. Okay, why are you using the effective rate now and not the market rate? Basically, this is the market rate of the simple loan without the adjustment of the transaction cost. So when you have adjusted the transaction cost, the revised effective rate is now 9.38. So if there is no concept of transaction cost in this question, you have to use the rate 9% as your effective rate. So 9% will be your effective rate if there is no transaction cost. But for that, after the adjustment of the transaction cost, the rate is slightly revised from 9 to 9.38. Should not be added to 92.5. No, transaction cost should be added in the value when there is a concept of financial asset. Actually, we are working on the financial liability portion. So here we have actually the liability. So therefore, we have to deduct. So I'm revising this concept that the transaction cost should be added in the financial asset, and it should be adjusted against the financial liability. Okay. So move on towards the next slide we have. Okay, Ji. Now we have the reclassification area. Now, equity instruments of another entity cannot be classified if it is on fair value through OCI. Because as I have already told you that in the category of fair value through OCI, you cannot reclassify. It is actually an irrevocable option. Only debt instrument for another entity can be reclassified. We are talking about financial asset right now. So amortized cost to the fair value through P&L. The debt instrument which is being previously measured at amortized cost means our intention is to hold that asset for long period up till the maturity, and the cash flows will be based on the interest plus principal amount. sorry, okay, principal amount. But remeasure the financial asset to its fair value with gains and losses taken to the P&L. When there is a change in the intention, now it's our intention that we wanted to sell it in a short term, or we wanted to place the asset, financial asset, for held for trading purpose, then you can use this by changing the category. So the reclassification or amortized cost from amortized cost to the fair value through P&L is allowed actually. And when there is a gain or loss in the values, it should be recognized in P&L. Fair value through P&L to amortized cost is also allowed. It also depends upon the change in the intention of the company. So let's move on towards the next slide. Yes, derecognition of the financial assets. When we derecognize the financial asset, when the right to receive the cash is either exercised or is transferred or is lapsed. So derecognition will depend upon these three factors. So if the right to receive the cash is transferred, we have to see whether the risk and rewards are transferred or whether the risk and rewards are not transferred. It means that it's an application of the factoring company case, that when we sell our debtors to a factoring company, we have to see that whether the risk and rewards of the associated asset has been transferred to the factoring company or not. Now, what are the treatments? If the risk and rewards are transferred, then we have to recognize by debiting the bank and crediting the financial asset. So we can de-recognize the financial asset. But when the risk and rewards are not transferred still, then you cannot de-recognize the financial asset. Instead, you have to book a financial liability. So this is the case for the factoring company. When the risk of the bad debts is beared by the factoring company, then we can use this entry. But if the risk of the bad debt is still beared by the company who is factoring its receivables, then company should have to book a financial liability unless the risk and rewards has been transferred. But if it is lapsed, then it should be charged in the P&L as an expense. And if it is exercised, then there will be a bank debit and financial asset credit. So these are some of the treatments for de-recognition of financial asset. Applying the rules of factoring, risk of bad debts has been transferred to the factoring company. So the accounting entry will be bank debit, receivable credit, and factor fees will be charged as an expense. Risk of bad debts beared by the company, so we have to book a financial liability for this. So this is again one of the most important areas which the examiner can ask you. When cash is received finally, so the accounting entry will be financial liability debit and receivables credit when it is cleared that the amount of the bad debt has been not more than the cash received from the factoring company. So the difference will be recognized. If there is some difference, it should be charged as an expense. Applying the rules of sale and leaseback. This is again an important point. You have seen this point previously in IFRS 16, that when we have sold an asset and objective is to buy back that particular instrument, then You have to debit the bank and credit the financial liability when there is a sale and buyback agreement. We have discussed this in day 1 or day 2 slides. There is a question from IFRS 9. But when there is a sale and buyback agreement for when there is a sale and buyback agreement, the accounting entry will be bank debit and financial asset credit and P&L credit. When there is a sale without buyback, then the accounting entry will be bank debit, financial asset credit and P&L credit. So these are the accounting entries for the sale and buyback of the. There is the last slide which I wanted to discuss with you is when the company has write a put option of equity instruments or debt instrument, this will be considered as a financial liability. And when the company has write the call option of the equity instrument, it will be considered as an equity instrument, and for the debt it will be considered as a financial liability. I have to give you the example. One is the writer and one is the holder. So if I have written the put option means when the holder will exercise, holder wanted to sell the asset to me. So it's my obligation to purchase my own shares. So it's my financial liability. And same for the debt instruments. My responsibility whenever the holder will exercise his option. So he wants to sell and I have to buy. So it's my financial liability till the date when the holder will exercise the option. Similarly, when there is a call option to the holder, means the holder have the right to purchase. So holder will purchase the shares, means I have to sell my shares or issue. So you know that very well that when we have issue our own shares, that is called equity, and when you have issue the debt instruments, that will be called as a financial liability. So this is actually the summary of some of the key provisions of financial instruments. We will discuss tomorrow the remaining part. The remaining part is now impairment and hedging of financial instruments. So the impairment part and the hedging instrument will be discussed tomorrow. Tomorrow we will be having a timing of 2 p.m. to 6 p.m. 2 p.m. to 5 p.m. sorry, rather than 6 p.m. to 9 p.m. So from day 1 to day 5, we are working from 6 p.m. to 9 p.m. But for day 6, there is a mock debrief session, and it's my humble request to all of you to please do attempt the mock exam. Tomorrow in the morning, I will send you the answers of the mock exam and we'll discuss the mock exam. So this is the night that you should have to solve the mock exam. Do not waste your time and try to attempt the mock exam tonight. And we'll discuss the mock exam tomorrow. So you have almost 12 to 15 hours to solve the mock exam. And so what is 2 p.m. UK time? No. 2 p.m. Means the Pakistan Standard Time. So you have to see in the international clock that what is the standard time of Pakistan. So it will be, I think, 10 a.m. in the UK. Okay. So I have no idea about the UK timings. So it will be 2 p.m. from the Pakistan Standard Time. So you can check the scenario. I hope my lectures will give you some benefits, and I hope 15 hours have added some value in you. But please try to utilize this time through regularly viewing these lectures on the Vimeo And at the same time, it's my request to please solve the mock exam tomorrow so that we can discuss the mock. Okay, 10 p.m. in UK is same in Canada. I'm not be able to make it. It's very difficult for me. Okay, IES IFRS summaries will be sent to you on the WhatsApp group. So stay connected with me on the WhatsApp group, and please try to read these concepts and try to memorize the basic concepts of each and every IFRS which we have discussed. Thank you very much for your time and take care of yourself. Allah Hafiz.